Listen, the bank went hard last week. It really had no choice. We saw a 50 basis point hike when the market had been anticipating, I think, 25 basis points. Had no choice from the perspective of credibility and the sense that inflation is just stickier, and they need to really tackle this. We've got levels of inflation that are double the levels in the US. So as we approach this week, I think there's a sense that this inflation, this recession that everyone's been talking about, is now really inevitable. And how are we positioning portfolios as the sort of days progress?
What's the trade then around the UK equity market? Because the FTSE 100 has come off some of the higher levels. Obviously, a little bit less impact when it comes to the interest rate story, but the FTSE 250 has been under pressure. So what's the trade around those two indices here in the UK?
Yeah, well, I think, listen, the narrative has shifted in the last few days. As I mentioned, that this recession that was very much forecast now seems to be inevitable. So what does that do in terms of risk assets? Well, from a domestic perspective, it means that the FTSE 250 is probably a little bit more vulnerable. I think there's a little bit more defensiveness about the FTSE 100. You've got that international exposure, and also you've got the currency to look at as well. I mean, year to date, sterling has been really strong, particularly against the US dollar. It's up 5% year to date. Um, a lot of that sort of strength in sterling was to do with the rate differential between US and UK, and also sort of weakness on US dollar. Um, the trade now will be, as we go forward, is, well, if rates do get to 6.25%, as swaps markets are now suggesting, what does that do to sterling? Does that mean we get this recession, and therefore sterling be a pro-cyclical currency? You might see that trade back a bit, and dollar strengthening from here.
Colleen, lovely to see you this morning. Why on earth should I buy at the London equity market when I can get low more money in terms of return without the risk from the short end of the gilt market?
Yeah, listen, it's a great question. It's a question we're asking ourselves at Wealthify. I mean, as we're looking at portfolios now, we have been able to take advantage of having a tactical overweight position to cash as we sort of positioned ourselves for this recession. So, and what we've been doing is exactly as you say, is we have been looking at gilts. We've been looking at the shorter end. We're now seeing 5.2%. Haven't seen those levels in a long time. It's interesting. If you go out the curve, out the 10-year, you're looking at 4.3%. That's interesting. So it's what you do, and it's that mix again between having the equity exposure to see you through the investment cycle, but be willing to take sort of the rough with the smooth as we go into a very volatile period.